All right, welcome back to another deep dive.
And if you're a regular, you know how we usually do things.
Yeah, we like to ease you into the week, a little macro overview, maybe a tech spotlight,
Something calm.
something calm. But today, we can't do that. We have to start with what is, basically a split-screen reality trick.
It really is.
Because if you're sitting in the U.S. right now, you're looking at your calendar, it says Monday, January 19th, 2026.
Martin Luther King Jr. Day.
Exactly. The NYSE is dark, the banks are closed, the algos are, technically sleeping. It's supposed to be quiet.
A moment of reflection, right?
Yeah.
But if you shift your gaze just a little bit,
Oh, yeah.
if you look at the futures markets or pull up a crypto terminal on your phone,
Under the dinner table, yeah.
there is absolutely no reflection happening. There was only panic. The world did not pause for this long weekend.
Not at all.
A huge geopolitical storm just broke out on Truth Social over the last 48 hours.
And now Europe is scrambling, defense systems are on high alert, and a lot of investors are looking at their screens with their jaws just on the floor.
Absolutely.
I mean, usually an MLK weekend is dead quiet. You step away, you enjoy the time off. But I'm looking at the futures, I'm watching Bitcoin, and I can tell you right now, there's no holiday for volatility.
No. The VIX doesn't take days off.
It does not. And the catalyst for all of this, for all the red ink we're seeing, it's what the trading desks are already calling the Greenland Ultimatum.
You almost have to read that headline twice.
You do.
Just to make sure it's not from, like, a satire site. President Trump, over the weekend, issued a demand. A complete and total purchase of Greenland.
And this isn't like the first time around, right? This isn't just floating an idea.
No, this was an ultimatum.
Yeah.
And the threat attached to it is specific, it's kinetic, and it's immediate.
Let's break it down.
A 10% tariff on 8 European nations starting February 1st.
Which is less than 2 weeks away.
It's less than 2 weeks. And it escalates to 25% by June if the deal isn't done.
And that deadline, that is what markets just hate. They hate uncertainty, sure, but they absolutely loathe a ticking clock.
A ticking time bomb.
So our mission for this deep dive is to unpack what this all means for your money.
Right. We're not just here to gawk at the headlines.
No. We are going to look at the crypto bloodbath that happened overnight. Bitcoin losing that critical $92,000 level.
We have to talk about the EU's retaliation, this so-called trade bazooka.
And the really scary part, the Sell America threat. The idea that Europe might actually start dumping U.S. bonds.
That bond threat is the thing that signals a potential structural change in how the entire global economy functions.
It really is.
But we also have some fascinating new data on who actually pays for these tariffs. Spoiler alert, a new study suggests it's probably you.
Of course it is. And we'll look at the few things that are actually green today.
Gold and silver, the old reliables.
So let's jump right into the center of this storm. The Greenland ransom. We're pulling from Bloomberg, The Street, Yahoo Finance, and they all lay out the president's demand.
He wants to buy Greenland.
And he's linking it directly to national security, to something called the Golden Dome.
Right. And the rhetoric here is really specific. It's a shift from, a vanity project to a supposed necessity.
Oh, so?
He claimed on Truth Social that this Golden Dome defense system can only work at its maximum potential and efficiency if this land is included in it.
So he's framing it as a non-negotiable security requirement.
Exactly. He even said world peace is at stake and warned about China and Russia circling the Arctic. So in his view...
Or the view he's presenting anyway.
Right, the view he's presenting to justify this economic hammer. This isn't about real estate. It's about a missile defense shield.
It's a classic leverage play. It's just the leverage is being applied to our closest allies.
And that's the part that's so shocking. Because Denmark, which, Greenland is an autonomous territory of...
They're not just going to hand over the keys.
No. So Trump has a target list. He's not just threatening Denmark.
Who's on it?
The sources list 8 countries. Denmark, Sweden, France, Germany, the UK, the Netherlands, Finland, and Norway.
Wow. So if you're exporting anything from those countries to the U.S.
You are facing a 10% tax in days and 25% by summer.
Just think about that list for a second. That is the core of the Northern European economy.
Germany, the UK, France.
Yeah. These are not minor trading partners, and the timing is just brutal. February 1st is right around the corner.
Can you imagine being a logistics manager at BMW or Airbus right now? Or Maersk?
You'd be losing your mind. You cannot pivot global supply chains in 10 days.
You can't.
And the administration seems to know that. They are squeezing them hard.
Mm-hmm.
We have the transcripts from Meet the Press. Treasury Secretary Scott Bessent was on Sunday.
And usually the Treasury Secretary's job is to calm the markets, right?
Exactly. Say, oh, it's just negotiations.
But he didn't do that.
No, he leaned right into it. He said, and I'm quoting here, Europeans' project weakness, U.S. project strength.
Wow.
He just completely dismissed the idea this would break up NATO. He argued Europe needs the U.S. security umbrella no matter what.
That is a staggering bet. It's basically saying you have nowhere else to go, so you will take this deal.
Right.
But the reaction from Europe suggests they are not just going to take it.
What are we seeing?
We have reports of protests in Nuuk, the capital of Greenland. People are marching to the U.S. Embassy. They're chanting Kalalit Nunaat, which is Greenland's indigenous name.
So they're asserting their identity.
And on the diplomatic stage, you've got former NATO head Anders Fogh Rasmussen calling this gangster behavior.
Gangster behavior. That's not the kind of language you usually hear between allies at Davos.
No, it is not. He also called it a weapon of mass distraction.
That is incredibly strong language from a former NATO Secretary General.
And it really highlights the disconnect, doesn't it? The U.S. sees a transaction, leveraging tariffs to get an asset.
And the Europeans see blackmail against a sovereign ally.
And when you have that kind of disconnect between the world's biggest trading partners, the markets, especially currency and bond markets, they start to get very, very nervous.
Because if you treat your allies like adversaries,
They might just start acting like them.
which brings us to the European response. Because this isn't like previous trade spats where there's a lot of talk and slow action.
No, the EU seems to be mobilizing immediately.
Yeah, we're seeing this term trade bazooka in the source material. Sounds like something from a video game.
It does, but the financial implications are massive.
So what's actually in this bazooka?
Well, according to AFP and the Financial Times, the EU is prepping countermeasures worth about 93 billion euros.
So over 100 billion US dollars.
Over 100 billion. And officials like German Vice Chancellor Lars Klingbeil, they're not mincing words.
They're using the word blackmail.
Openly. Klingbeil said Europe will not be blackmailed. They're readying a package to target U.S. imports directly.
So 100 billion in retaliatory tariffs. That's a huge hit to U.S. exporters. We're talking everything from, I don't know, bourbon to Boeing's getting slapped with duties.
Yeah.
But there's something else in the sources that I think is much, much more dangerous than just taxing some blue jeans.
The financial nuclear option.
Yes. Tell us about that.
This is the anti-coercion instrument. It's a legal tool the EU developed. Actually, they were thinking of China when they made it.
And now they're applying it to the U.S.
Looks like it.
Uh-huh.
But the real threat, the one that should keep bond traders awake at night, it comes from an analysis by Deutsche Bank's George Saravelos.
Okay.
He points out that European entities hold $8 trillion in U.S. bonds and equities.
8 trillion.
$8 trillion. That's almost twice as much as the rest of the world combined.
Okay, let's unpack that for everyone listening because this is the core of the Sell America threat.
Right.
The U.S. government runs on debt. We issue treasuries to fund the deficit, pay the military, keep the lights on. We need people to buy that debt.
And Europe buys a massive, massive chunk of it.
So if they stop buying, or worse, if they start selling, what happens to the guy in Ohio with a mortgage?
It's a terrifying domino effect. If the geoeconomic stability of the Western Alliance is being disrupted existentially, which is how Saravelos puts it,
Which it is?
Europe might decide they no longer want to fund the U.S. deficit. So they start dumping U.S. treasuries.
The price of those bonds fall.
When bond prices fall, yields, the interest rate the U.S. has to pay to attract buyers, they skyrocket.
Which means borrowing costs for the government go through the roof.
And it's not just the government. It spikes mortgage rates, credit card rates, car loans for everyday American consumers because all those rates are often pegged to treasury yield.
It's financial warfare.
It is.
It effectively bypasses the Fed. I mean, the Fed might want to cut rates, but if Europe dumps $1 trillion in bonds, rates are going up no matter what.
And we have seen this before, right? The sources mentioned Danish pension funds started reducing their dollar exposure last year.
Exactly. So this isn't just a theory. It's an emerging trend, the Sell America trade.
If political alliances fracture, financial alliances are usually right behind them.
We've just assumed for 70 years that Europe will always buy our debt.
And if U.S. is threatening to, effectively annex territory from a NATO member and tax the rest of them, that assumption becomes very, very shaky.
And while the bond market is sitting there pondering this nightmare scenario, which usually takes days or weeks to play out, The crypto market just completely collapsed over the weekend.
It absolutely did.
I mean, we talk about crypto as a hedge, right? Digital gold.
Sometimes.
Looking at these charts, it did not act like gold at all. It acted like it saw a ghost.
No, it acted like a high beta risk asset. It behaved exactly like a leveraged tech stock. The second that uncertainty hit,
Flush.
total flush. Bitcoin fell right below that psychological $92,000 level.
Specifically touched lows around 92,400, according to the CoinGecko data.
And it wasn't a gentle slide, was it?
No, it was a cliff. And the liquidation numbers are just staggering.
What are we looking at?
Somewhere between $865 and $870 million in liquidations across the market in just 24 hours.
And for anyone who doesn't trade futures, can you explain what that really means?
Sure. This isn't just people deciding to sell their coins. This is the exchange forcibly closing out your position because you ran out of money, you got liquidated.
And the breakdown of those liquidations is really telling.
It is. 90% of them were longs.
90%. So the vast majority of people who lost their shirts were betting on the price going up.
They were bullish. They saw the uptrend from early January, and they thought it would continue. They were borrowing money to bet more.
And then the Greenland news hit. The floor just fell out from under them.
And all those leveraged bets were just wiped out automatically. It's a classic long squeeze, a bull trap.
And it wasn't just, retail traders panicking on their phones, was it?
No, not at all. The sources point to some serious whale activity. This isn't just shrimp and crabs selling.
Right. The on-chain data suggests insiders sold something like 22,000 Bitcoin.
And we saw major outflows from Coinbase, from Bybit, from Wintermute.
That's institutional selling.
That is the smart money moving to the sidelines or cashing out before the U.S. market even opened.
It suggests they don't see this Greenland issue resolving quickly. They saw the MLK holiday as a liquidity trap.
Markets closed, no easy way to exit.
So they got out of the one asset class that trades 24/7.
I have to mention one little detail from the sources that made me chuckle, even with all the red ink.
Okay.
Apparently, Jim Cramer had warned that markets were too overbought to bounce.
The inverse Kramer indicator.
The infamous inverse Cramer. In the crypto world, there's this running joke. If he says sell, you buy. If he says buy, you run for the hills.
So some traders jokingly took his warning as a bullish signal.
They did, and unfortunately for them, the indicator failed this time. The drop happened anyway.
It just shows how desperate traders were for a bullish signal, doesn't it?
Yeah.
They were looking for any reason to stay long.
And they got hit by a geopolitical brick wall. It's a reminder that memes are fun.
But macro always wins in the end.
So crypto is down. Bitcoin broke 92K. Ether's down almost 5%. Solana's down almost 9%. If crypto isn't the safe haven, where did the money go?
Well, capital doesn't just vanish.
Right.
It relocates. It seeks shelter.
Yep.
And it went to the classics. It went to physical stuff. Gold and silver.
Okay.
While Bitcoin was shedding $100 billion in market cap, precious metals were rallying hard.
Silver was the standout, right?
It was the absolute standout. We have reports of silver rising nearly 8% to $77.20 an ounce.
That is a massive move for a commodity. Usually you see a 1 or 2% move in metals and people get excited.
Right.
8% is a breakout. It's like a tech stock earnings beat.
It is. And gold hit record highs as well, touching $4,660, according to some data points.
So this is the flight to safety trade in its purest form.
Textbook. When investors are scared of trade wars, scared of currency devaluation, or bond market instability.
They buy hard assets, things you can hold in your hand that don't depend on a government promise or an internet connection.
Exactly.
There is one other sector that's seeing green, and it's grimly predictable given the news.
European defense stocks.
Yep. If you're a trader looking at the board, you see red everywhere except for gold miners and missile makers.
It makes sense if you're threatening to break up NATO or telling Europe they're weak and need to defend themselves.
The market assumes Europe is going to have to spend a lot more money on tanks and missiles.
So we saw shares of Leonardo in Italy, Rheinmetall in Germany,
BAE Systems in the UK, Thales in France, all trading higher.
The market is pricing in a more militarized, more independent Europe.
It's the fragmented NATO play. If the U.S. umbrella gets shaky, Europe buys its own umbrellas. Okay, I want to pivot now to something that really affects everyone listening, not just the traders. We talk about these tariffs, 10%, 25% as these abstract numbers or political poker chips.
Right.
And the administration, specifically President Trump, loves to say these tariffs are a tax on foreign countries. that we're extracting billions from China, or in this case, Germany.
That is the political talking point, for sure. We will tax them until they pay up. Sounds good on a bumper sticker. But we have a brand new study from the Kiel Institute for the World Economy that was released right in the middle of all this. And it completely dismantles that argument with hard data.
The numbers in this study they're brutal. What's the actual breakdown?
So the study analyzed who actually bears the cost of these duties. They followed the money.
And they
found that 96% of the tariff cost is passed through to U.S. importers and consumers.
Wait, hold on. Pause on that. 96%.
96%.
So for every dollar in tariffs collected by U.S. Customs, 96 cents comes out of American pockets.
Exactly. It functions as a consumption tax, effectively. Right. The researchers looked at data from Brazil and India who faced steep tariffs last year.
Right.
The theory the White House pushes is that, say, a Brazilian exporter would lower their price to keep their U.S. market share.
But they didn't.
The data shows they did not. They didn't lower prices to offset the tariffs. They either kept their margins or they just sold their goods somewhere else. The global market is big enough.
So the U.S. importer, the company bringing in the goods, let's say a furniture store importing wood or a tech company importing chips, they have to pay that tax at the border.
Mm-hmm.
And they're not just going to eat a 25% cost increase. Their margins are probably only 10% to begin with.
Of course not.
So they pass it to the retailer, who passes it right on to us at the checkout counter.
Precisely. The study calls it near complete pass-through. And in an environment where inflation is already a concern,
right,
adding a 10 to 25% tax on goods from our major European trading partners, think German cars, French wines, Dutch electronics,
that is going to show up in the CPI. It's inflationary.
So this Greenland Ultimatum isn't just a diplomatic issue. It's a direct hit to the purchasing power of the American dollar.
Okay, so let's summarize the board right now.
Let's do it.
We have a trade war that could spike inflation for consumers. We have a bond market that is threatened by an $8 trillion sell-off.
We have crypto crashing because it's a risk asset, not a safe haven.
And we have gold and defense stocks rallying because the world suddenly feels a lot less safe.
That is quite the cocktail for a Tuesday morning open.
It really is. And you have to remember, the U.S. market has been closed for 3 days.
Just sitting on the sidelines while all this news piles up.
When that opening bell rings on Tuesday, all of that pent-up reaction is going to hit the tape at once. Yeah. It's like shaking a soda bottle for 72 hours and then twisting the cap. Which brings us to strategy, the Theta Fuse part of the deep dive.
Yes.
And honestly, for a volatility trader, this is the environment you wait for. The VIX, the volatility index, is likely going to spike and spike hard.
Volatility is back. For a long time, the markets have been just grinding higher, very calm.
That is over.
The Greenland Ultimatum has injected a massive dose of uncertainty. So explain to the listener why this matters for their portfolio if they aren't, a day trader.
Well, for an options trader, high volatility, a high VIX means options premiums are expensive.
Fear makes insurance expensive.
Exactly. So it's a good environment for theta strategies, which involves selling that expensive premium and letting time decay work for you.
You want to be the one selling the insurance when the hurricane's on the radar.
Not buying it. But there's a huge risk, right? You can't just sell blindly.
Huge risk.
You have to be so careful about the gap down if you're selling put options thinking, oh, the market will hold.
And then Germany announces they're dumping bonds and the market opens down 2%.
You're going to get run over. You'll be underwater immediately.
So where do we look for a floor? Where's the support?
The support levels are critical here. We're watching Bitcoin, obviously. It broke 92K. The next major support level is in the mid-80s. If 90K breaks decisively and we don't see a bounce, look out below.
The buy the dip crowd has been trained for years that every single drop is an opportunity.
They have. But this situation with Europe, it feels different.
I agree. That is the big question, isn't it? Is this a dip or is this a regime change?
Where do you land on that?
I'm leaning toward the latter being a very real possibility.
Yeah.
This isn't just about trade balances or steel quotas.
No.
This is about the fundamental structure of the Atlantic Alliance. If the U.S. and Europe are in an economic war, the entire flow of global capital changes.
And the Sell America threat is the black swan.
That is the black swan. If we see European pension funds actually starting to dump treasuries on Tuesday or Wednesday, that changes the interest rate environment for years.
Which changes the valuation of every single stock on the market. High rates compress PE ratios.
Right. If the risk-free rate goes to 6 or 7%, Why would you hold a risky tech stock earning 3%?
Stocks go down. So the smart money move right now seems to be diversification.
Yes. Diversification into hard assets. We're seeing it in the gold and silver moves.
And potentially into those sectors that benefit from chaos, like defense.
It's about hedging. You can't just be long the S&P 500 and hope for the best when the two biggest economic blocks on Earth are threatening each other.
Yeah. I have to play devil's advocate here.
Go ahead.
We have to look at the art of the deal factor. We've seen this movie before with this president. He threatens the impossible by Greenland or else to get something else entirely. Maybe a better trade deal, maybe lower tariffs on U.S. goods.
That is the counter-narrative, isn't it? That this is just an extreme opening bid.
Right. The sources mention the China rare earth dispute. Trump threatened, China restricted exports, markets panicked.
And then they negotiated, and things normalized.
Exactly. So it's very possible that in 2 months, there's no Greenland purchase, but maybe there's a new trade agreement that favors the U.S. a little bit more.
And if you panic sell everything today, you might miss that massive relief rally when a deal is struck.
The market loves a resolution rally.
So the takeaway is don't panic sell, but definitely hedge. And keep an eye on that $8 trillion bond number.
That is the leverage point. That's the fuse.
That fuse is lit.
The explosion in the financial markets will make a crypto crash look like a minor correction.
I think we'll wrap it up there. It is going to be a fascinating week. Keep your passports ready and your portfolios hedged.
And keep your eyes on the bond yields. That is the real story.
It is.
And as always, let the theta burn. We'll see you on the trading floor.